Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings. This Quarry Inc. 10Q filing is, well, it is quite a read. Let's dive in and see what is really going on because this company is navigating some serious financial turbulence. So Quarry Inc. filed their latest quarterly report, a 10Q, for the period ending the 30th of September 2025. This is basically a mid-quarter checkup on how a company is doing financially, and folks, the numbers here paint a pretty stark picture. Let's start with the balance sheet. Think of this as a snapshot of what the company owns, what it owes, and what is left over for the owners. As of the 30th of September 2025, Quarry had total assets of about $20.8 million. That sounds like a decent number, but compare that to the 31st of December 2024, when it was almost $27 million. So their total assets dropped by about $6 million in just 9 months. That's a significant shrinkage. On the other side of the balance sheet, we have liabilities, so what they owe. Their total liabilities are about $15.4 million in both periods, but here is where it gets interesting. See that little line item, accounts payable and accrued expenses. For the 30th of September 2025, it's almost $4.4 million, up from about $4 million at the end of last year. That's an increase, meaning they owe more to their suppliers and for other immediate expenses. Now, for the owner's shareholders' equity, this is what's left after you subtract liabilities from assets. We're seeing a massive drop here from about $11.5 million at the end of 2024. It's plummeted to just over $5.4 million by September 2025. That is a loss of about $6 million in owner's stake, directly reflecting that shrinking asset base. Moving on to how the company is performing its income statement, or in their case, probably more accurately, their loss statement. For the 3 months ending the 30th of September 2025, they reported net sales of just over $1.3 million. That sounds okay, but wait, this is a huge drop from the same period last year when they had almost $4.8 million in sales. That's a 72% decrease. For the 9 months of the year. Sales fell from $19.1 million in 2024 to $12.2 million in 2025. That's a 36% drop in revenue. And what about that profit margin? Well, for the 3 months ending the 30th of September 2025, their gross margin was negative $1 million. That means for every dollar they sold, they spent more than $1 to make it. A year ago, they actually had a positive gross margin of about $96,000. For the 9-month period, their gross margin also went from a small positive of $179,000 to a negative $1.8 million. They are literally losing money on every sale. This, of course, leads to a growing loss from operations. For the 3 months ending the 30th of September 2025, their operating loss was about $2.5 million, more than double the loss from the same period last year. And year to date, their operating loss is almost $7 million, a huge jump from $3.6 million in 2024. And then to raise the interest expense, companies often borrow money. Quarry owes a lot and it costs them. For the 9 months ending the 30th of September 2025, they spent over $2.2 million on interest. Compare that to last year when they paid about $4.7 million. So it looks like they spent less on interest this year, but that's partly because their total debt also decreased a bit. However, this interest expense is still incredibly high relative to their sales and operational performance. All of this adds up to a significant net loss. For the quarter ending the 30th of September 2025, their net loss was about $3.7 million. That translates to a loss of 17 cents per S-hair. A year ago, their loss was $4.4 million or 25 cents per S-hair. So, while they lost less money on paper this quarter compared to last year's quarter, the overall trend for the year is not good. For the 9 months, their net loss was a staggering $9.3 million. That's a loss of 44 cents per S-hair. Looking at their sales breakdown, you can see pretty significant drops across all their product categories: diesel, liquid asphalt, VZO, and naphtha. Diesel sales alone dropped 84% for the quarter and 43% year to date. Liquid asphalt sales also took a hit, down 44% for the quarter and 12% year to date. This decline in sales is really the core of their financial problems. And when you look at their cost of goods sold, it is not coming down nearly as fast as their sales. For the quarter, their cost of goods sold was $2.3 million, while their sales were only $1.3 million more than what it cost to produce. For the year, they spent $14.1 million to produce goods that brought in only $12.2 million in sales. This is a recipe for disaster. Now let's talk about expenses, particularly general and administrative. These went up, not down. For the quarter, they were $1.5 million, up from $1.2 million last year. For the year, they're over $5 million, a big jump from $3.8 million last year. A significant chunk of this is executive compensation, which went up 20% for the quarter and 22% year to date. It seems like no matter how bad the sales are, the management costs keep climbing. The overall picture leads to a substantial loss before taxes. For the 9 months ending the 30th of September 2025, this loss was over $9.3 million. This is down from a loss of $10.5 million in the same period in 2024. So a slight improvement there, but it's still a massive hole. Let's talk about cash. This is the lifeblood of any business for the 9 months ending the 30th of September 2025. Sky Quarry used almost $2 million in cash from its operations. That's less than the $4.6 million they used last year, which is some small comfort, but it still means they are burning through cash just to keep the lights on. And their total cash at the end of the period, September 2025, was only $362,000. That's down from $385,000 at the end of 2024. While the decrease isn't huge, it's their only safety net with such high operating losses. Their debt situation is also concerning. While overall liabilities haven't changed much, a closer look at debt shows it remains a significant burden. They have notes payable of almost $2.8 million that are not due within the next year, and about $6.4 million due within the next year. This heavy debt load, combined with their operational losses, explains why they have serious going concern issues. And that leads us to the scariest part of any financial report, the going concern section. The company itself admits there are material uncertainties related to events and conditions that cast significant doubt upon their ability to continue as a going concern. They have an accumulated deficit of over $33 million, and they are burning through cash. They've had to raise money through loans to fund operations without additional financing. They cannot pay their bills. This is a critical warning sign for investors. Let's look at their inventory. For September 2025, inventory is about $1.3 million, down from $3.1 million at the end of 2024. This drop is mainly in finished goods. Companies often reduce inventory when sales are down or if they are struggling to sell their products. We saw accounts payable increase earlier, and it's good to see what makes that up. Trade accounts payable are about $2.3 million for September 2025, down slightly from $2.7 million at the end of 2024. However, accrued expenses have jumped significantly from $1.2 million to $2 million. This suggests they owe more for things like salaries, utilities, and other services that haven't been paid yet. This company has a lot of warrants. Think of warrants as options to buy company stock later. The value of these warrants can change, and it affects the company's financial statements. Their warrant liability is valued at $338,000 as of September 2025, down from $459,000 at the end of 2024. They recognize gains or losses from changes in the value of these warrants, and in 2025 they actually had a gain of about $120,000 from this, which helped offset some of their other losses. But this is a non-cash item, meaning it does not directly impact their operating cash flow. The debt section is a bit of a labyrinth with high interest rates. We see loans from lenders like Libertas, Private Lender A, and Lenspark, many with extremely high interest rates like 58% or 68%. This is a classic sign of a company in financial distress. Having to borrow from lenders who charge exorbitant interest because traditional banks won't lend to them. And looking at the maturity dates, many of these loans are due very soon, adding to their liquidity crunch as we discussed in the going concern section. They also have something called mandatorily redeemable preferred stock. This is like a debt obligation because the company is obligated to redeem it at a certain time. They have about $297,000 in this category with significant interest or dividend payments associated. Now let's talk about employee compensation, specifically stock options and awards. They have a stock option plan, and the company granted a significant number of shares to officers, directors, and employees. Share-based compensation expense for the 9 months of 2025 was over $46,000. While this is a way to incentivize employees, it also dilutes the ownership of existing shareholders, and of course the impact on shareholders. For the 9 months ending the 30th of September 2025, the net loss per S-share was a negative 44 cents. That's a significant chunk of value lost for every share owned. The company operates in one main segment, refined crude oil. They produce diesel, liquid asphalt, and other petroleum products. However, they are also developing a second segment, the 2020 Resources LLC PR Spring facility, which is currently not bringing in any revenue, but does have associated development costs being capitalized. They expect this facility to be completed in the summer of 2026. The decrease in net sales is widespread across all their products. Between the 3 months ending September 2025 and 2024, sales dropped by 84% for diesel, 44% for liquid asphalt, 84% for VGO, and 85% for naphtha. This shows a deep problem across their entire product line. The company reported a loss from operations of $2.5 million for the quarter and $6.9 million for the 9 months in 2025, significantly worse than the prior year. This lack of profitability is a major red flag. This section is all about cash. They had negative operating cash flows and a very small amount of cash on hand. Their monthly cash burn rate is over $237,000. They acknowledge they need to raise more capital through debt or equity to survive. The decrease in cash and total assets, along with the increase in liabilities, points to a company under immense financial pressure. They are very clear about needing additional cash for operations and capital expenditures. They are not generating enough cash flow to cover costs and are relying on issuing more debt or selling stock. Looking at the cash flow statement, operating activities show a significant cash drain. Investing activities also show cash being spent on property, plant, and equipment, but at a lower rate than last year, likely due to their financial constraints. Financing activities show them borrowing more money and paying it back, but overall, the picture is one of continued reliance on external funding. There is an interesting note within the controls and procedures section about management's evaluation. They state that their disclosure controls and procedures were not effective to provide reasonable assurance that information is properly communicated for timely disclosure. This, coupled with the CFO resigning and an interim one stepping in, suggests internal control issues are also a concern. The company mentions that in the ordinary course of business, they are involved in various legal actions. However, they believe these are not expected to have a material adverse effect on their financial position. This is standard boilerplate, but something to keep an eye on. As a smaller reporting company, they are not required to detail their risk factors. This is a bit of a relief for them, but it means we don't get a detailed official list of what could go wrong. They issued a significant amount of stock for services and to pay interest on loans. This means they are essentially giving away ownership in the company to get basic operational needs met. This can be a dangerous strategy if not managed carefully. Finally, the exhibits include certifications from their CEO and CFO attesting to the accuracy of the report, and of course the ex-bureau files that allow for digital analysis of the financial data. Now, for my take on Quarry Inc., based on this report, the company is in a very precarious financial position. Their sales have plummeted, they are losing money on every sale, and their losses are widening. They have a high debt load with very high interest rates, and many of their loans are coming due soon. The fact that they admit they may not be able to continue as a going concern is a serious red flag. The increased general and administrative expenses, including executive compensation and professional fees while sales are collapsing, is also a worry. The company is heavily reliant on raising new capital either through debt or equity, but with their current performance and going concern warnings, attracting new investors or lenders will be incredibly difficult, and if they do get money, it will likely come with extremely unfavorable terms like the high interest loans we're already seeing. The hope for Quarry lies in the reopening of their refinery in 2026 and the development of their PR Spring facility. However, those are future events and the company needs to survive until then. Based on these numbers, survival looks incredibly uncertain. The significant drop in revenue and the resulting inability to cover costs suggest a deeply troubled business. Alright, that's our breakdown of Quarry Inc. Its latest filing, what's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions. Thanks for watching, see you next time.